This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian markets are facing a manic Monday as US futures gap lower and apparent hedge selling. A weak jobs report now has bond traders betting on aggressive Fed rate cuts to avoid a recession. Also ahead, Apple's Asian suppliers in focus after Warren Buffett's Berkshire Hathaway sells almost half its stake. Plus, inside Adani, Bloomberg gains unprecedented access to the leaders of the Indian conglomerate as it cements a succession plan and battles fallout from the Hindenburg short seller attack. We do have a week of special coverage beginning this hour where we hear exclusively from the group's billionaire chairman and the founder, Gautam Adani.
In fact, basically these Hindenburg issues of this last year was a Adani Group history is the highest performance.
We do have some Australian PMIs and certainly trending in the direction that suggests that weakness in the economy is starting to really pass through. This is a final reading for July. The Judo Bank Australian PMI composite number coming in at 49.9, so falling below that 50 threshold from 50.2 in the previous reading. The services PMI is still maintaining above that 50 threshold, but only just really 50.4, also declining from 50.8. The composite PMI is actually the lowest reading since January this year. We've seen net orders also falling to the lowest since December 2023. That is a second consecutive month of contraction. We've also seen employment falling as well. When it comes to the services PMI, we're seeing that lowest reading since the start of the year as well. And certainly employment in that gauge is the lowest since December 2022. The RBA, Shery, is set for that hawkish hold, really looking like they're trailing their peers as the sort of fervour over the easing cycle globally continues to pick up pace.
Economic indicators so important now as global risks continue to rise, right? Especially in the United States when we saw the jobs data on Friday triggering the recession indicator SAM rule, the unemployment rate unexpectedly ticking up. So now you have traders pricing in more than a full percentage point of Federal Reserve rate cuts. And that coming at a time when we've already seen the massive bond rally that continues right now, the biggest since the March banking turmoil of last year in the U.S. But really, it's about that rotation, really given the moves in the bond markets and also when it comes to the stock markets, bad news no longer being good news for equities.
It's really fascinating, isn't it? Just that just one or two pieces of data kind of just change the cumulative narrative of this market. And you're right, you talk about that rotation, that pretty violent stock market sell-off that we saw last week, triggered by these fears that the Fed may have, be sort of behind the curve and miss the opportunity for that soft landing, ending one rotation trade. It may have started another. Investors are kind of guessing where equities now head from here. The players, dividend players, according to Wealth Alliance, some of those sort of impact of tumbling yields have put the spotlight on utilities and REITs in particular. We're also kind of seeing the build up to what could be a pretty turbulent end of 2024. We spoke to a number of experts and they all kind of think that not just the Fed and this sort of difficult part of the end of this cycle, but also the risks when it comes to the presidential election in November and the heavy conversation that we've seen in these markets in big tech.
And really that tech stock hit being felt across Asia as well, right? I mean, we saw those chip makers taking a hit across Asia, not to mention those AI-related shares, whether it's power energy companies or other infrastructure companies. The Kospi seeing its worst day in about 4 years. For the Nikkei, it was sort of a different story because we also had the Japanese yen strengthening. So the Topix seeing its worst day since 2016 as the Japanese yen saw the best week in a couple of years already as well. So the Japanese yen and now holding at below that 150 level, continuing its strength against the U.S. dollar, as we're seeing Sydney futures also losing more than 1% at the moment, given, of course, that we're headed towards the RBA rate decision that you just mentioned, and we're watching Chinese futures and how they will trade at the open, given that we got more of a understanding and details when it comes to the priorities of Beijing in boosting consumption. Take a look at what happened in the U.S. markets. We took a look at some of the broad sector rotation, including the Nasdaq 100, which is now in correction territory. But as you mentioned earlier, it's really about that rotation trade because we saw those utilities and real estate stocks seeing the best performance last week across the S&P 500. And you can see oil at the moment rebounding slightly after falling to the lowest level in 7 months, given those recession concerns, Heidi.
Yeah, and in fact, to that end, Goldman Sachs, Shery, increasing the probability of a US recession in the next year to 25%, up from 15%, but also says such a risk is limited as they do see room for Fed rate cuts. Our next guest says while the US labour market does face pressure, those challenges may be overstated. Gary Ng is a senior economist for APAC thematic research at Natixis and is with us now. And hopefully, Gary, we're looking for, words of comfort here, right? Because I do wonder what has meaningfully changed in the data, even just over the past couple of weeks, that has shifted the narrative from maybe there's still components of sticky inflation to the Fed has missed the window to be able to execute a soft landing.
Well, I think if we look at the general economic picture in the U.S., it's quite fair to acknowledge that the pressure is growing, especially from what we see in the labor market. But however, whether this really overplayed by the market, I think this is also one of the questions that we have in mind, because if you look at the services sector in the U.S., it's actually not as worse as it looks on the surface. And of course, we have service PMI coming out tonight, and that will probably continue to show the ongoing expansion. And if we think of it even from the inflation side, yes, demand may be pushing prices to go down further. But if you look at food and energy prices, or the geopolitical tensions, the potential upcoming tariff depending on the election result, all of these factors are basically pointing to the fact that inflation may be more sticky than it looks on the surface. And therefore, with the current market pricing or interest rate, it's possible that it is really overpricing, it's really giving it an excuse for a sector rotation only.
So that brings me, further to our question of the day for our MLive blog, which is this: are traders right to bet on a big Fed cut? And that's our question of the day. The labour market obviously showing some signs of deterioration. We're seeing the focus shifting to a larger cut. Is 50 basis points right to you? Do you think that's a possibility?
Well, I think a 50 basis point in September is basically quite a difficult scenario to imagine, because in the short run there are basically different risks that the Fed may not be able to cope with at the moment. So it will need to keep rate at a relatively elevated level, which is where we are right now. So I think it's more possible to see a 50 basis point not in September, but altogether in 2024. Basically, the U.S. needs a lower rate, but not rates that is as low as the market is pricing right now. And again, I think November is really a very uncertain factor that the Fed will not be able to basically forecast the election outcome and all the potential policies. We need to get closer with a few more data points and the result before we actually see a clearer picture. But of course, from the market perspective, there could be speculations.
Where does the Chinese economy stand in all of this? We get a slew of data this week, but we have seen the weakness continue now for years. Is this a non-factor when it comes to what the Fed does going forward, or will it affect global demand meaningfully?
Well, I think the China story hasn't really changed much since the beginning of the year. We have seen more policies being rolled out. There's a gradual shift from the supply side policy towards demand, but the magnitude is not strong enough to actually convince consumers and corporates to consume and invest more. So at this point, it's still quite likely that we will see quite a good performance on the export side of China, but this is not enough to actually pull China out of this inflation or this weak consumption story, etc. So it's pretty much in a scenario that Chinese growth will probably still decelerate in a mild way. And for the U.S., of course, for the demand side, it's not something that is very meaningful. The worries is probably on the supply side that there could be more goods being flooded into the global market, which should be helpful for the U.S. in terms of the inflation. But again, we have geopolitical tensions in the equation, so it's probably not enough to actually pull rates down.
Gary, when it comes to consumption here in Japan, for example, would a stronger yen help confidence among Japanese people? And could we see that spending sort of offset perhaps some of the drag that we might see if we get a stronger Japanese yen really pushing the other way when it comes to inflation? I mean, we saw prices sustained because import prices rose until now.
Well, indeed, I think one of the core problem opportunities in the future is that whether Japanese real wage can actually turn into positive growth, which will fill into this positive cycle that the BOJ is hoping for in greater consumption because of the weaker import price influence, etc. So I think on the consumption side, this is definitely one of the positive factors that we see despite all this market turmoil that we see right now. So if the yen is able to sustain at a higher level, and if real wage in Japan actually turns into positive growth, it's possible that, well, the situation right now may not be as worse as it looks on the surface, because Japanese economy is actually undergoing structural changes right now, including the equity market.
Gary Ng, senior economist for APAC thematic research at the Natixis, with a look ahead at the big key eco data that we should watch out for this week, including, of course, we will have to look at the RBA expected to stand pat this week. We'll also be talking about Fujitsu shares have been gaining ground this year in the double digits. They will come on and share their outlook about the Japanese IT services company beating expectations for quarterly operating profit. We'll also talk market strategy with Morningstar as traders bet the Fed going into rescue mode. Plus, as our special week of coverage begins of India's Adani empire, we talk about the key risks facing the group with the Indian School of Business. This is Bloomberg.
Well, today we begin special coverage of one of India's biggest and most controversial business groups. In our exclusive interview with its billionaire founder, Gautam Adani, he reveals how he's putting in motion, Shery, one of the world's largest and certainly most challenging succession plans.
Yep, and that's even as the Adani Group continues to face fallout from the short seller report that last year, remember, wiped $150 billion from its market value. Adani also dismisses allegations that the conglomerate's dominance in key sectors of India's economy is due to his relationship with the Modi government.
It's been a volatile few years for Gautam Adani. The Indian billionaire has built the Adani Group into a sprawling conglomerate that controls large and critical infrastructure projects in one of the world's fastest growing economies. While it's made Adani one of the world's richest people, it's also attracted accusations of cronyism over his close ties to Prime Minister Narendra Modi, as well as questions about corporate governance. In January 2023, those concerns erupted onto the global stage when short seller Hindenburg Research accused the Adani Group of fraud and stock price manipulation. Though they denied those allegations, the report still triggered a $150 billion meltdown in shares of the group's listed firms and cast a shadow over the company, just as it was eyeing a wider global play. The stocks have since then pared most losses, and the Adanis have tied up fresh lines of bank and equity financing and won a reprieve from India's Supreme Court. But fears linger as investigations by India's market regulator and the U.S. Department of Justice continue. It's with this backdrop that the 62-year-old founder spoke to Bloomberg's Anto Antony to say he's setting in motion a succession plan that will hand the running of his massive conglomerate in about 8 years to the next generation of his family, which he dubs the G2. Adani limited on-camera questions to succession. We asked him about the impact the short seller report and its aftermath had on this transition plan.
Mr. Adani, you said that the succession plan was conceived about 10 years back. Now the last 2 years incidents, the investigations, Hindenburg report, has it affected it in any way, the implementation?
In hindsight, I can say that it is this incident makes family more together and work very hard to fight it back. And I definitely basically see that they have converted this incident into the great opportunity for family uniteness. Secondly, they work hard, and whatever corrections in each and every aspect of our businesses we have to do. And in fact, basically this Hindenburg issues of this last year was a Adani Group history is the highest performance.
Many people attribute your business growth to how you strategize your company's priorities to that of the government's priorities, whether it is state or center. Is that something that you will ask the next generation to continue?
No, so that is basically group has decided, irrespective of the government. Okay, when whatever the government basically decide the priority for the nation's point of view, we always basically focus our business in that direction. And I strongly believe that when you basically business directions towards government priorities, you always basically get the tailwinds and not the headwinds. And that helps your group to grow faster.
That strategy has meant the Adanis now control big chunks of India's infrastructure, including ports, airports, and data centers. So the decision on how the Adani Group will be managed in the future will have ramifications beyond the conglomerate and the family.
Tell us about your succession plans. What steps are you putting in place to ensure that this goes on smoothly for the investors, the family, as well as the company?
Succession is a very, very important for the business sustainability. And it must be organic, gradual, and a very systematic. Succession is not one of the events, but it is a long-term journey. And my plan of succession started almost a decade ago. And I gradually inducted our G2, Pranav, Karan, Sagar, and now Jeet. And the successions will be completed according to my planning in next 8 to 10 years. And all the G2 members of our family were given the best of the professionals' educations. They were also trained in the fundamentals of each and every businesses. They started as interns with our professional CEOs, and gradually they evolved into the leadership roles. Today, all of them looking after the different businesses, and I'm very satisfied with their progress. I'm really proud that all 4 of them are very, very hardworking and very grounded, and they enjoy their work, and most importantly, they all still hungry, which is not very common among second-generation entrepreneurs.
What systems are you putting in place to make sure that the group continues to grow without any internal conflicts?
These integrations will never happen in the Adani Group. When I gave the G2 the options of independent businesses, they decided collectively that they want multiple businesses but one family. So they have a strong unity among themselves. The succession is all about both continuity and change, and it is a gradual process. This will ensure that the succession is seamless, is a smooth, and a sustainable. The structural succession plan is supported by a strong cultural values. Our values provide the glue that holds together our arrangements.
And once the transition is complete and once you have more time at hand, what would be your plans?
Ultimately we will retire and be more relaxed.
The Adani Group Chairman Gautam Adani there speaking exclusively with Bloomberg's Anto Anthony. And for our special coverage of the Adani Group continues all week. Tomorrow we'll be asking Gautam Adani's elder son, Karan, about taking over one of Asia's biggest logistics businesses and about those claims that the Adani Group is too close to the Modi government.
being close to a political party does not necessarily mean that you get the work. You get the work because you are able to deliver.
And our coverage culminates with a special report on Friday at 11:30 a.m. Hong Kong time with an encore presentation at 7 p.m. That's 4:30 if you're watching in Mumbai. More ahead on the Asia Trade. This is Bloomberg.
Berkshire Hathaway has slashed its stake in Apple by almost 50% as part of a massive second quarter selling spree that boosted Warren Buffett's cash pile to a record $277 billion. For more, let's bring in finance reporter Catherine Doherty. Catherine, so how much is the unloading of Apple shares, but also Bank of America, for example, have to do with just profit taking? Or could it be about confidence in these companies?
So on Saturday, Buffett reported that his conglomerate has cut almost half of its position in Apple. That was during the second quarter. But it's not the first time that they have revealed a selling of Apple's shares. Earlier, during the annual meeting for Berkshire, they talked about selling Apple. It was a release that they signaled as a reduction as a concentration of risk. And they also referenced that it was trimming the position to balance out the holdings, and that it was also related to some sort of tax management. So it wasn't a complete surprise. However, this latest announcement does come amid a broader concern about the potential for an economic downturn. So that's where Bank of America, Berkshire has cut its stake in the bank by 8.8% just in July through August 1st. So that is drawing more concern about a possible reflection that Berkshire and Buffett are showing investors, saying that there could be some potential headwinds to come with the economy.
So there's some concerns about the U.S. consumer, of course, but also what are the expectations that they'll do with that pile of cash, right? Because even buybacks seem to be too expensive now.
That's correct. So Berkshire has said that this is an issue that the firm is having, that they're in no rush to just put that money to work. They're struggling to find ways to deploy their mountain of cash. This is as prices are rising, deal activity has stagnated. So Buffett has said, again, they're in no rush to spend it unless they think there is something that has little risk and can make them a lot of money. So they're waiting for that period and that potential opportunity to put their money to work.
A finance reporter, Catherine Doherty, there with the latest on Berkshire Hathaway. And that'll just be one of the trading themes to the downside. We'll be watching, particularly when it comes to those Asian Apple suppliers, as the trade gets underway here in Asia this Monday. This is Bloomberg.
Growth scare, policy mistake. That is what I'm hearing. That is what you're seeing from the price action.
I think there's a bit of an overreaction here. 114 is still a really strong number. I think we were used to these outsized numbers when we were recovering from the pandemic.
This is the first time that I have a growth scare. In the past, I kept on saying there's no reason for the U.S. to fall into recession.
I think the price for interest rates is wrong today. I mean, should they have moved? I don't know that they were set up to move, given what they had told the market prior to this.
I do think that we are seeing some of that nervousness around the economy playing through right now, and that might make the first Fed rate cut less extreme.
I think the market now fully understands that the Fed may be late.
Some of our guests reacting to Friday's U.S. jobs report and the Fed's rate path. ahead. And of course, that's really the dominant theme, that rotation, what we potentially rotate back into and how that's setting up. And we have seen that gapping when it comes to US futures. And as we get that carry through to Asian trade, we could see some more kind of sector-specific sell-offs, in particular watching the impact of that cutting of the stake in Apple by Berkshire Hathaway and how that sort of trickles through to some of the suppliers and the tech names in Asia. Sydney futures looking pretty bleak at the moment, 1.5% lower. Take a look at Singapore Nikkei futures. We're off by 4.6%. Of course, Japanese markets have really struggled for a little while now. And certainly, even though there is a lot more to this market than just the impact of the yen, the strength in the yen certainly is not helping the state of affairs and sentiment, right? Investors are kind of wondering if this is a catch a falling knife situation when it comes to coming back in with all these signs of a capitulation, particularly when it comes to the topics. S&P futures, they're also off by just about 1%. So the weak US jobs data, the unexpected jump in the unemployment rate, really triggering the famous SARM rule, that recession indicator with a perfect track record over the past 50 years. The acting US Labour Secretary, Julie Su, discusses those numbers and the economic outlook.
We, look at the three-month average. The three-month average in growth is still 170,000 jobs. Remember, we spent a year talking about how the numbers were too high and too hot, and we had always planned for a transition to a more sustainable, steady level of growth. This number did come in below expectations. It's still over 100,000 jobs. It's still broad-based. We saw growth in multiple industries. We saw it in construction. We saw it in healthcare. We saw it in leisure and hospitality. There was a dramatic drop in one industry, information. But generally, this is an indicator of continued strength in the economy. And when you look at other things, including labor force participation, which is at an all-time high for prime age workers, and we continue, know that there's continued work left to do to make sure that we maintain a strong economy. But we're still at a three-month average of above the number that President Biden said a year ago we need to be to have a sustainable, strong labor market in a strong economy.
The unemployment rate came in at 4.3%, and Claudia Sahm has already said that this has now triggered the SARM rule, which basically means we potentially are on the cusp of a recession. How concerned are you in the White House about that?
Well, we're not concerned about that specifically, in part because the unemployment rate that it grew from has been so historically low and has been so historically low for such a long time. I believe even Claudia Sahm herself expressed some questions about whether the rule applies when you start at 4% or just above 4% unemployment rate. So again, we have to keep in mind, these numbers come in not in a vacuum, but as part of a overall picture of an economy that we've been talking about for some time, that did not happen by accident, that was not inevitable, in which there's been tremendous growth and an economic recovery that is, frankly, the envy of the world. And so we know that the work is not finished. We know that you don't get. We don't stop doing the work that we've been doing. But one example of the effectiveness of the president's economic policies is that some of the growth is being driven by private investment into areas in which the president's Investing in America agenda has brought in public investments. And so those investments continue to hit the street. We'll continue to keep delivering them in different communities, and we'll continue to watch the numbers.
The acting US Labour Secretary, Julie Su, there speaking with Bloomberg's Anne-Marie Hordern. Let's take a look at the morning calls ahead of the Asia trading day and week. And let's get back to that Goldman Sachs call. Economists are saying the probability of a US recession in the next year has increased to 25% from 15%, following that jobs data for July showing the slowdown in hiring and the jump in unemployment. But they also note the US economy continues to look, quote, fine overall, and the Fed still has a lot of room to cut rates. They're predicting a 50 basis point cut in September if the jobs print for August, Shery, remains weak.
Yeah, Haidi. And when it comes to Japanese stocks, asymmetric advisor is expecting the country's equities to be subject to more risk-off selling. That's on the back of the underwhelming jobs data out of the U.S. They say high levels of volatility in the market make it impossible to favor risk, but they add high-growth companies in Japan have experienced a big contraction in the last 2 years, and more pressure would drive them to extremely attractive valuations. Now, that may be one of the reasons why some investors still have faith in their long-term outlook. Joining me now here in the Tokyo studios, our Asia equities reporter, Winnie Su. Winnie, is it just about the fundamentals of this stock market?
Yeah, so fundamentals remain strong, and people are also saying that, the wage growth and also the pricing power. So these longer-term factors are still there. BlackRock is still overweight on Japanese stocks. And just over the weekend, we saw SocGen and Goldman Sachs. They both said that, this time the Friday sell-off was mostly driven by flow. And once that big selling pressure is over, people are going to be able to focus more on the fundamentals and valuation. And JP Morgan actually also said that the people right now think they're pricing in the appreciation of the yen, but that might actually be overdone.
But then the selling pressure that you just mentioned, that's expected to remain at least in the short term?
Yes, absolutely. So when you look at the Friday big sell-off, right, they're driven by all different types of factors. You have the more macro factor about the worries around the U.S. Heading into recession and the U.S. tech earnings, but also the uncertainties around the election, right? But more importantly, around the yen. And it's not just the appreciation of the yen, also the volatility of the yen, accompanied by the expectation for more hawkish BOJ and the continuous reversal of the carry trade. So when we think that investors are potentially pricing in the yen to go to as strong as 140 against the dollar, that means there's still going to be more room for that to weigh on Japanese stocks.
Winnie, what are the sectors that are particularly interesting right now?
Right. So when you think about what has been sold off, it's really the ones that have really outperformed in this big rally. There were the trading companies, the financials, and especially the exporters that really benefited from the weak yen. So we saw a lot of the sell-off in that area, and people are looking into rotating into the domestic companies or the mid or small caps companies that are more likely to gain when the yen is stronger. Some still have faith in financials if they're pricing in more BOJ rate hikes to come.
Asia Equities reporter Winnie Su there. Let's take a look at some of these other asset classes, particularly when it comes to the mood music for the energy markets at the moment, given these concerns of a US and broader slowdown, as well as some of those geopolitical concerns continuing to play out. Oil, we've seen really climbing from that 7-month low there. Israel is sort of continuing to brace for that retaliatory attack from Iran, as well as potentially some of its proxies as well. We've seen Saudi Arabia also hiking its prices to Asia, but cutting them for the European and the US markets as well. But certainly we are starting to see these escalating tensions in the Middle East really intensifying ahead of a potential retaliatory strike. And that is starting to, albeit we saw that sort of being outweighed by perhaps some of the demand and supply issues in the US, but that is starting to play out as a main theme for energy markets at the moment. We are still looking for crude, though, about 4 weeks of declines, largely on the back of these concerns about faltering demand out of US and China. Equity futures, of course, Shery, pointing to that further broader sell-off.
Yeah, talking about sell-offs, take a look at how the Mexican peso is trading at the moment, because, of course, we had the strength of the Japanese yen now at the highest level in about 6 months against the US dollar. And we know that the Japanese yen has been a cheap funding currency for the Mexican peso, which already sank on Friday. It's actually been sinking because of this unwind of carry trades against the Japanese yen. And we continue to see the downward pressure when we're talking about the weakest levels since January of 2023 for the Mexican peso against the US dollar, on concerns, of course, of risk off, that we might potentially head into a hard landing in the United States. All of that factoring into this yen currency. We have more ahead on the Asia trade. This is Bloomberg. And we're just away from the market opens in Japan at the top of the next hour. Take a look at how we're trading with the Japanese yen, seeing incredible strength at the moment against the U.S. dollar, of course, after that rate hike unexpected that came from the BOJ last week, that really sending stocks down. The topic seeing its worst day since 2016, and we're seeing Nikkei futures pointing to the downside at the open. One stock that we'll be watching is shares of Japanese IT company Fujitsu that have gained about 13% year to date, and Bloomberg Intelligence now saying the profit expansion could pick up due to robust order gains at Fujitsu Uvance, which includes AI services. This as the company focuses on transforming itself into a technology giant. Joining us now is Yoshinami Takahashi, Corporate Executive Officer at Fujitsu and also the COO of Fujitsu Uvance. It's really great to have you with us here in the Tokyo studio. So tell me a little bit about what you're expecting to see in terms of progress achieved as you're trying to make this digital transformation happen.
Yeah, thank you so much, Shery. We see a lot of companies in Japan trying to kind of formulate a transformation. So in the few years ago, many of the companies were thinking about how to kind of optimize costs. That's why they went from on-premise to cloud. Change order, get into kind of facing the labor shortage. They want to kind of maximize the efficiency. But now, what we see from the Japanese companies, not only in terms of total cost of operation, but they want to leverage AI to do it better for the sustainability and also improve the profitability of the company. So we see a lot of strong traction from many of the Japanese companies really getting into a data intelligence, AI infusion into Japanese market.
You've actually worked for Sony.
Yes,
You've also worked at Microsoft, right?
Yes, yeah.
Do you see any differences in trends when it comes to how Japanese companies are adopting this digital transformation solutions as opposed to, say, the rest of the world?
Yeah, that's a great question. I think adoption of technology, especially for the U.S. companies, has been very fast. In the past, Japanese companies, I think, has been quite slow because adoption of on-premise to cloud, I think cloud adoption is maybe a little over 30% right now in Japan. But again, many of the executive officers in Japan are really changing right now. So we see a lot of positive traction among the Japanese company executive really getting into the DX. This is the trend of past 2 or 3 years. So it's really changing.
When you talk about labor shortage earlier, the Japanese economy, of course, faces that chronically.
Sure.
In your company, too, you've actually tried to beef up when it comes to consulting staff, for example, by 2025, right? How much progress have you made in that hiring? Are you seeing the level of skill set and expertise that you want here in Japan to be able to hire?
Actually, as you mentioned, it's not so easy to kind of hire new skilled workers. So it's kind of everybody's fighting for those talents. At the same time, within Fujitsu, we're trying to do a lot of reskilling. So a change from system engineering to a consultancy. So we spend a lot of investment on the employee training. So we think not only recruitment, but also training the internal staff to convert. I think that's also another important element, making sure that we have skilled resources within Fujitsu. So it's going to be a combination. Yeah.
What would be the incentive then to go to Fujitsu versus perhaps competitors like Accenture, right? What are some of the policies that maybe you're looking at the moment?
That's a great question. I don't want to kind of compare with the other competition, but in principle, I think Fujitsu is capitalized by the very technology. So I think not only that we're kind of focused around DX or sustainability transformation, but we have a very core in our companies like technology. So you may notice that we are very much into a supercomputer. And one of the key reasons of the people coming into Fujitsu is because they are believing that this power of computing and AI is going to change the world. So we see a lot of new talents coming into Fujitsu, expecting that as a technology company, we can do so many things for the society. I think that's the kind of motivation for the people coming into Fujitsu.
I'm glad that you talked about AI and how that's... Yes, and I'm glad that you brought up AI because that's obviously a key part of what we wanted to talk to you about and how much you expect this to contribute to the broader business performance. How does that play out? Because obviously the broader markets and investors at this point have this sort of concern that's overwhelming at the moment that all of this investment going into AI is obviously going to take some years to start paying dividends.
Yeah, I think we should give some time to the development of AI. But already within the, all the generative AI that's popping up in the, on a global basis, that's actually contributing to the automation. So that means with more limited resources, the companies are being able to do more. And I'm not only talking about the a day-to-day process. This AI is going to change that, is going to accelerate the automation. But when you look at AI, it can be leveraged for drug discovery. So that's more like a transformational AI. And also minimizing of CO2 emission, rerouting of a truck, buses, all the things that AI can contribute to kind of give a better, make a better society better. I think those are the impact that we see in the next few years that's coming up.
The demand for digital transformation has really helped offset some of that tepid sales when it comes to the hardware side of things, right? Where do you see recovery in that sector when it comes to hardware, telecommunications, network systems, and all of that, at a time when we're also all of a sudden seeing a resurging yen?
That's a very good question. I will talk about Fujitsu because I cannot talk in general. But the company itself, we've been transforming from hardware, a device sales, to a more service solution company. So even depreciation of yen in the past few years did not really impact Fujitsu because we've been changing our business portfolio quite heavily. Close to 60% of now business or a revenue is coming from service solution than hardware devices. So I think many of the companies now in Japan is changing the portfolio very rapidly. So I'm seeing a very positive notion, even though appreciation of yen or depreciation of yen, whatever exchange rate fluctuation does, I think the Japanese companies are now able to cope with these kind of changing dynamics.
Yoshinami Takahashi, really good to have you with us in the Tokyo studio. He's a corporate executive officer at Fujitsu, and we do have much more ahead. Catch Japan Ahead every Monday at 8:40 a.m. if you're watching here in Tokyo, 7:40 p.m. Sunday in New York, and of course subscribers can watch live on the terminal using the TV Go function. This is Bloomberg. Asia's earnings spotlight is shifting to Japan this week. Tokyo Electron and Laser Tech will report the results on the heels of chip titans SK Hynix and Samsung. Operating profit at Tokyo Electron probably grew at the fastest pace in almost 2 years. Meanwhile, consensus shows that Laser Tech's chip-related product sales could drop 50%. Also keep an eye on SoftBank's earnings. Bloomberg Intelligence says the group probably remained profitable in the first quarter thanks to demand for AI products. Bloomberg earnings reporter Rena Sasaki joins us now for our preview of a couple of the biggest companies here in Japan, right? Rena, talk us through what's happening at Tokyo Electron because the projections seem to be pretty optimistic.
Yes. So Tokyo Electron will be reporting on Thursday, and we're expecting its first quarter operating income to grow the fastest level in 2 years, thanks to the demand recovery in chip making equipment and the sales growth in memory chip tool for artificial intelligence for Chinese customers. Despite the disappointing results and forecasts from its biggest supplier, Intel, its Chinese and its South Korean customers such as TSMC, Samsung, and SK Hynix strong result from last month show optimisms for Japan's largest chip equipment maker.
Although I do wonder how long that optimism can last at a time when we're seeing this huge reversal out of tech and perhaps some disappointment that those investments on AI haven't necessarily paid off and you don't have a clear picture of when they will start paying off. SoftBank is also reporting, and it's really about those AI products as well.
Right. So SoftBank will be reporting on Wednesday, and we're expecting its earnings to stay profitable thanks to its chip designer ARM Holdings and its telecom unit SoftBank Corp. However, the volatility from the Vision Fund may offset its profit contribution, and the investors are watching out for even more unstable earnings in the future with riskier investments as increasing exposure to hardware and an energy-related infrastructure that may be prove costly for the company.
Anything else that we should be keeping an eye for this week, given, of course, we're in the thick of earnings season? How have they been doing so far when it comes to Japanese companies?
Right. So Japanese tech, the chip and equipment makers are expected to post robust earnings. As you mentioned, LaserTech's fourth quarter results may plunge this quarter. However, on the fiscal year level, they might grow about 20% thanks to its strong earnings from the last 3 quarters.
Bloomberg's earnings reporter Rena Sasaki here with me in the Tokyo studio, looking ahead to the earnings season here in Japan. And of course, we do have breaking news out of the BOJ. We're getting the minutes for their latest June policy meeting. One BOJ member saying that there are upside risks to prices, that they had become more noticeable. Of course, Heidi, this is the June meeting when the BOJ held rates steady, and they said that they plan to cut debt buying, but they actually did not provide any details of that bond cutting measures until this latest July meeting. So we're getting perhaps a little bit more clarity on what their thinking was.
Right, which is entirely necessary, right, given that we have just a broader kind of reassessment by Bank of Japan watchers and investors about what this trajectory of interest rates and really pulling forward the forecast after we heard that hawkish messaging from Governor Ueda and that earlier than expected rate hike, right? In fact, at the moment, about 70% of economists that we've polled see another increase this year, and that is just such a big kind of shift in that view as well, right? Only a fifth expecting a move by early next year. BOJ members just reiterating that yen weakness was an upside risk to prices. And Shery, this is kind of core to what we're talking about, right? Even though they don't officially look at the currency, clearly this was a major driver in why they decided to go earlier and to kind of fix that momentum that we saw in the yen's rebound.
Yeah, and what a difference a month makes, right? We are at the Japanese yen trading at that below 146 level against the US dollar right now. We'll get you the market opens in Tokyo, Seoul, and Sydney next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. Heidi, of course, we saw that massive sell-off, the worst jobs day in the U.S. since October of 2022. No longer bad eco data is good news for the stock markets. That rotation continues to happen, and that bond rally, the biggest since the March turmoil in banking.
Yeah, 50 basis points for the Fed is now being seen, right? We have Goldman Sachs weighing in, lifting their recession risks from 15% to 25% for the U.S. economy, albeit saying that it's okay because the Fed still clearly has ample room to ease. But as you were saying just in the last hour, what a difference just a few weeks makes in terms of completely shifting the narrative.
The Japanese yen now trading below that 146 level against the U.S. dollar as we continue to get the latest lines from the BOJ minutes from their June meeting. Remember, that was when they held steady. They talked about cutting bond purchases, but not necessarily giving us any details. They said back then that the yen really depreciating gives rise to upright risks when it comes to inflation, when it comes to FX short rate moves, that they would not be really deciding policy for them. But take a look at the Japanese yen, because after that rate hike from the BOJ, unexpected last week, and also the signaling of the Fed when it comes to rate cuts, now sending the yen to the strongest level against the U.S. dollar since January of this year. The Nikkei also continuing its slump. The topics already had seen its worst day on Friday since 2016, down almost 2% right now. We continue to get that real pressure when it comes to those Japanese exporters, and really people recalibrating where the stock markets in Japan may go from here. You have the 10-year yield also below that 0.9% level. Take a look at the Kospi, because we saw another really bad day when it comes to the Korean stock market, the worst in about 2 years or so. And this really to do with also the rotation out of those big tech names. So those high-flying Korean chip makers, not to mention anything AI related, whether it's power companies or infrastructure companies taking a hit across South Korea. And the Korean won staying steady at that 1360 level against the U.S. dollar. Haidi.
We're now seeing that shift, Shery, following the Fed, following the Bank of Japan. On the back of all this data, the focus is on the RBA, right? They are set for that hawkish hold. A lot of questions, though, given that this is a central bank that's really already being seen as behind the cycle when it comes to potential easing. A lot of weakness that we're seeing through when it comes to the Australian economy, including those PMI numbers, at least one of which fell into contraction territory for that composite reading earlier this morning. But we're still kind of near the back of the global easing cycle. Local inflation is cooling but remains elevated. That 12-year high for the key interest rate at the RBA looks like it'll stay there for now, as we've seen at least further tightening being priced out of these markets. Take a look at how we're opening up when it comes to the staggered start to the session for Aussie equities, off about 0.4%. Of course, it was only late last week that we saw Australian stocks hitting that fresh record high. A lot of strength across miners and property stocks in particular. It'll be quite interesting to see whether that kind of outlook for Australian equities starts to get boosted as that rotation out of the lead from the US continues to play out. We're seeing the Aussie dollar actually a little bit on the back foot there, 64.96, despite, of course, the moves that we've seen in the greenback. And watching treasuries as well. Obviously, on that Friday session, we had that big move, the surge in treasuries, particularly when it comes to the yield on that 2-year falling over 30 basis points to the lowest in a year, as bond traders really reposition on a half-point cut from the Fed in September.
Haidi, our next guest, is picking up cheap, high-quality companies, but expects more defensive names to hold up a bit better in the near term. Joining us now is Lorraine Tan, Director of Asia Equity Research at Morningstar. Lorraine, great to have you back. But when we talk about cheap and high quality, how difficult is it to get these names, and where are they?
Yeah, hi, good morning. I think when we look at where the valuations are, I mean, that would be our primary focus. I mean, we're looking really at those that have underperformed, or rather will have the opportunity to fall back to what we would call much more attractive levels to pick up. I mean, those are the names that we're looking at. And if we look at the markets in Asia, a lot of the undervaluation still was in the China-Hong Kong markets, but there are some sectors that were also underperforming that we think has trades on relatively attractive levels. So we're beginning to see, we started seeing the rotation into more yield plays in the second quarter. We expect that to continue to carry on. I mean, some of the stocks that we would position for at the short term would be some of the S-REITs. I mean, in China, we would focus on the domestic consumption plays. We do think there's still more positive policies that would shore those names up, and we would focus on domestic to avoid geopolitics, of course.
Lorraine, here in Japan, we're seeing a massive sell-off continue into the Monday session. We're talking about the topics extending those losses by more than 3% early at the open. And this, of course, after seeing its worst day since 2016 already on Friday. So what are investors looking at here in Japan that gives them pause at this point? Because we thought that the Japanese yen strength, yes, it could have implications for the Japanese stock markets, but there's more subtlety now, given that exporters are not necessarily that affected by a cheaper or stronger yen anymore.
Yeah, it's one of those things. I think it's a pure offsetting move that when we had the Japanese market go up, 40% last year, that coincided with the yen's decline as well. So, obviously in US dollar terms, the valuations are somewhat stable in that sense. For the Japanese market, I think we would still focus on the names that maybe have that get pulled up as the Chinese economy recovers, particularly on the manufacturing side. We still see some of the high-quality Japanese names, for example, the factory automation side, Fanuc for one, as being proxies to the China recovery. So that would be one angle that we would look at for Japan. And really, those factory automation names have lagged the broad Japanese market. We do like the Japanese banks, but they were at relatively expensive levels. So as they pull back into more cheaper valuations, that's another sector that we would look at as well. We do think overall the interest rate policy in Japan will help the returns on equity of the Japanese banks going forward.
Lorraine, I wanted to get a little bit more specifics about your kind of waiting patiently to pick up value in China right at the moment. And I suppose that forms part of some of your Japan thesis as well, in terms of parts of corporate Japan that could benefit from the China recovery. What does that recovery look like, and where do you see the beneficiaries in the earlier on? Because we're not seeing sort of big bang moves really from policy easing at the moment.
Yeah, to be honest, I mean, we've had to push back a lot of our expectations for China over the past year and a half. Where we do see it is we're just looking at purely valuation grounds. I mean, some of the areas, the domestic areas that we like best are, for example, the Baijiu sector. We do like that. There's some high quality names like Maotai that are coming into attractive areas. Where we would anticipate things to start to improve, I mean, we're really looking at consumer confidence and consumption here. And some of that will have to come with a stabilization in real estate prices. Now, we are seeing signs that the inventory absorption is beginning to happen in terms of excess inventory, with the local governments buying up, with some of the excess stock. And we do feel that we should start to see real estate prices start to stabilize into early 2025. In 2025 sometime, we hope to see a bottom in that. And I think as soon as that bottoms, we should start to get a little bit more confidence into the real estate space, into home prices. And that's what I think will drive consumer confidence going forward.
Lorraine, I'm glad you mentioned Maotai, because that's actually one of the stocks, obviously, that we're watching as the price continues to plummet, right? There's two sides to this. If you take a look at this first chart, which obviously on valuations, cheap with PE at the lowest in half a decade, it's fast, sort of hurdling one standard deviation below the mean. On the other hand, on technicals, these momentum indicators looking at some of the worst conditions on record, right? That 14-week RSI below 30 at historic lows. When you take a look at this kind of divergence, and it's not just Maotai, it's a number of stocks within China, right? What sort of holds more weight for you at this point in the narrative?
We still look at where the value is. We focus on that, and we look through the cycles. And you're having a dip in the spending now, which is quite steep. We see a lot of the valuations coming down and reflecting this concerns on earnings. But once you look through the cycle into what we think is the median sort of sustainable consumption patterns, we do think that there is value in most of the Baijiu names at the moment. We do like, obviously, the top grade names best, because we see these as the opportunities. And Maotai, obviously being a premium producer, we still expect the company to hold its ground in terms of market share going forward. There is a premiumization trend in China overall that would be sustained. Do note that these companies, and Maotai as well, sits on cash. We do expect the potential for dividend payouts to rise as well.
It's a sea of red in early Asia trading right now. The Kospi also seeing its worst day since 2020. Of course, a lot of those tech-named chip makers, AI-related stocks are getting hit. Is this a good time to enter this sector?
Yeah, so the chip names have been interesting, because I think if you look at Asia itself, the technology sector didn't really outperform in the second quarter, except maybe for a couple of names like the pure chip plays at TSMC, Samsung, SDI, and MediaTek. If you look at the broad sector, there were a number of laggards that we do like in the chip space. But now that the top names are coming back down, like TSMC, we probably take a look and again prioritize picking up the high-grade names. The broad tech sector, we actually, in terms of industry, we actually do expect things to improve with the inventory cycles still moving up. So those are positives for the tech space. I think they were just running ahead of valuations. There's no real change to our expectation for the industry longer term. So yes, we would pick those selective names up as they come down as well.
Lorraine, always great to chat with you. Lorraine Tan, Director of Asia Equity Research at Morningstar, with some investing food for thought there. More ahead on the Asia trade. This is Bloomberg. Let's take a look at some of the market calls that we're following today. Goldman Sachs economists say the probability of a US recession in the next year has increased to 25% from 15% after jobs data for July showed a slowdown in hiring and a jump in unemployment, but also noting that the economy continues to look fine overall and the Fed still has a lot of room to cut rates. They're predicting a 50 basis point cut in September if the jobs print for August remains weak.
And Haidi, asymmetric advisors expecting Japanese stocks to be subject to more risk-off selling. That's on the back of that underwhelming jobs data out of the U.S. They say high levels of volatility in the market make it impossible to favor risk, but they add high-growth companies in Japan have experienced a big contraction in the last 2 years, and more pressure would drive them to, quote, extremely attractive valuations. Well, investors don't seem to be looking at that, at least for today, because we're seeing continued losses for the topics at the moment, more than 6% after already having suffered the worst day since 2016 on Friday. Take a look at the Nikkei, down more than 5%, and even the Kospi in South Korea. If we end up at these levels for the day, we would have entered correction territory, down 10% from its July peak. The ASX 200 in Australia ahead of RBA Day as well, down more than 2%. But let's talk a little bit about Japan, because of course the stock market calculations, the BOJ gyrations and policy going forward really has sent an entire generation of Japanese citizens knowing nothing but near zero interest rates. But now they're gearing up for a time where potentially bank deposits could yield 0.1% a year. Bloomberg opinion columnist Gaurav Reddy has been looking at Japan's brave new world and joins us now. Gaurav, good to have you with us. I mean, are we going to see this brave new world if, say, the global economy goes down in flames?
I mean, it's a very good question. It certainly would be in keeping with the Bank of Japan's past rate hikes to have chosen the worst possible time to have hiked rates. That's what happened in 2000. It's what happened in the mid-2000s as well. And judging by the, what we're seeing in the market right now, you would have to wonder if Governor Ueda will actually be able to follow up with his pledge to keep hiking rates if the forecasts continue to be in line with what the bank expects.
How big is sort of, so much of this is down to kind of the deflation mindset, right? Are we starting to see a change of that from households and consumers? And how big of a signal is this that the Bank of Japan has done this and is really signalling that more will come and perhaps much sooner than expected?
Yeah, it's the big question here, I think, when you're dealing with Japan is policy has been, quote unquote, abnormal for so long. It's not always easy to predict what ways companies and consumers are going to respond to what would otherwise be relatively small shifts. So we've seen a very small shift in rates higher, and look at the market reaction that you have up on screen at the moment. Of course, that's not just down to Japan, but obviously Japan is seeing way more outsized moves than other markets are. The deflationary mindset, I would say itself, is starting to change. People have become accustomed to prices rising, and companies have been much less afraid to increase prices than they were in the past, when they would cut their own margins and cut salaries and things like that instead. But the question is, how are people going to respond to, let's say, to higher mortgage prices, to the other effects of higher interest rates that we're going to see across the economy? It's very difficult to tell how people are going to respond to that. You might think that people would spend more because, their money is going to be worth less in a year's time in an inflationary environment. But that might be not what happens in Japan, because it often does not work the way that you think it would.
Gaurav, so when it comes to the BOJ, we understand that they've been really trying to change the mentality and mindset in that deflationary spiral here in Japan. But how much has it to do with the BOJ itself, and how much has it to do with the fact that Japan has been changing either way? We have a new generation of people willing to, say, change how the labor market operates.
Yeah, for me, the interesting thing about this time compared to the previous times that they tried to hike rates unsuccessfully is that there's this tremendous labor crunch in the Japanese economy, affecting all sectors of the Japanese economy at the moment. That means, that previously the effects that you might have seen from what might be a premature rate hike, as I'm looking at the numbers on the screen again there, they might be different to what you've seen in the past. Like I say, things are changing regardless of what the BOJ does. It's not necessarily all down to the BOJ where the Japanese economy goes. For me, the labor crunch is definitely one of the most interesting parts of that, and that is also feeding into a different kind of attitude towards people, different attitudes from firms, having to raise wages kind of regardless of what the BOJ does, just in order to attract talent. That's making the situation on the ground potentially different, I think, to what it was before.
Bloomberg opinion columnist covering Japan and Korea, really there with the latest on the Japanese economy, and take a look at how some of the big movers are trading in the Japanese session, because we have some real reactions to the earnings season. Because take a look at Nintendo. It's a down day overall, but they actually saw their profit diving 71% when they announced earnings. We're seeing consumers holding off on purchases, so that really sending the stock down. And Fankel also under pressure after missing the average analyst estimate when it comes to their first quarter operating income. And of course, we're following the financials because we have seen big gyrations when it comes to those financials in Japan, because last week, of course, we saw the optimism and gains in Japanese banks because of that rate hike from the BOJ. But then as the week progressed, we saw a big slump in financials as, of course, we have seen more caution when it comes to the broader global economy, especially with those jobs numbers out of the U.S. Haidi.
Yeah, and Shery, we'll continue to watch really the market gyrations, right? That volatility signal being very well taken by the start of trading. We're about 20 minutes or so into the start of trading across major markets. And you mentioned earlier the Kospi taking losses from the peak in July to 10%. We've now seen that circuit breaker has been triggered for the topics. That will be in place until 9:26 a.m. this morning. We're also watching the reaction when it comes to treasuries. A two-year yield sinking 9 basis points to the lowest since May 2023. Japan's Topics index has now fallen 20% from its July peak as well. So real capitulation here. And I do wonder, as I'm Live blog has been talking about, and Garfield Reynolds saying this route perhaps looks overdone unless we actually are on the cusp of a recession. But you can see really the kind of narrative that markets are running with at the moment is that there has been a policy error potentially by the Fed, that they've moved too late, and that, we are now seeing that reaction, that two-year yield dropping to the lowest now since May 2023. Big moves in these markets so far this Monday morning. This is Bloomberg.
We continue to see big downsides in the Japanese market. We're talking about the Topics losing ground to a point that circuit breakers have been triggered for the Topics index until 9:26:13 a.m. Japan time. We're talking about losses continuing after the worst day since 2016 in the Topics index. And this as the Japanese yen continues to gain ground against the U.S. dollar. We already had the strongest week since 2022. We're now seeing the Japanese yen at the strongest level since the start of the year in January of 2024. One sector that's seeing big losses is the banking sector, with the Topics banking index down 14% at the moment, Haidi.
Yeah, and of course we're still watching the economic weakness out of China as well as another sort of downside trigger for these markets that have quite a bit of bad news or bad expectations kind of playing out so far, right? China's government issuing a 20-step plan to boost consumer spending. Weak domestic demand continues to weigh on growth. Our China correspondent Minmin Loh joins us now with more. So Minmin, this new action plan, what does it entail?
Yes, so China's State Council, which is its cabinet, has issued this 20-point guideline to boost consumption. It looks at exploring the potential of consumption in areas like food and accommodation, elder care and child care services. It also wants to foster new types of consumption, for instance, in e-commerce, live streaming, e-sports, the so-called Internet Plus medical services. And it also wants to foster new types of travel as well, such as RV camping, yachting, low-altitude flying, for instance. So pretty specific in terms of the types of sectors that they want to support. There are also policy support measures for households and businesses. You can see on the screen there, financing support for certain eligible small and micro enterprises, personal income tax deduction to offset the cost of elder care and infant care, as well as credit support for certain types of service consumption. And this suggests that there is a clear signal that the government is aware of what is not working in the economy. They are taking steps to address it, but a big question as to whether this will go far enough, given that the property sector is still in the doldrums and much of people's wealth is still tied to the property sector.
Yeah, Mimi Lo there, as we also await that trade and inflation data later in the week. But take a look at how markets are trading at the moment, because it's a broad down day across Asia. We're talking about the Nikkei and the topics falling, and the topics now with a trigger of circuit breakers until 9:26:13 Japan time. We are seeing also the Kospi. If we close at these levels, we would be in correction territory as well. This as global yields continue to fall. We're talking about the Treasury 2-year yield at the lowest level since May 2023. That jobs data on Friday really having massive fallout across the world. This is Bloomberg.
We'll take a look at these markets, and certainly there's sort of a sense of capitulation at this point, right, when it comes to this narrative that markets are really running with, that potentially the Fed has made that policy error and that we are going to see that risk of recession elevated. The Goldman Sachs call about rising risk to about 25% from 15% certainly didn't help. Neither did, of course, the news that Warren Buffett and Berkshire Hathaway cut that stake in Apple so significantly as well, and just sitting on that cash pile with nowhere that they particularly want to deploy. We're seeing now a lot of action when it comes to that circuit breaker being triggered for Japan's Topix index until 9:23 a.m. Japan Standard Time. We see, of course, the big move, the decline of 20% for the Topix from the July peak. We've seen some of these other market moves as well. The decline in the Kospi, losses to 10% from that July peak as well. So we are also watching, of course, that flight to safety there. 2-year yields for treasuries dropping 11 basis points, lower since May 2023. And the question, Shery, I guess, and it's one that, is aptly addressed in our MLive blog, is that, this seems to look like a rally that would suggest that we're on the cusp of a recession. And has the data that we've gotten over the past few days really, painted that narrative?
Yeah, and probably not surprising given that we had the SAM rule triggered, and this was a very closely recession indicator that was watched by markets. Now the unemployment rate unexpectedly climbing for a fourth month in the U.S. The 3-month moving average has now risen more than a half percentage point above its 12-month low. So really those recession fears just ballooning as Goldman economists also increase the probability of a U.S. recession to a modest, say, a 25% from 15%. But just the fact that, as you said, the narrative has changed, right? Earlier last week, we saw perhaps more optimism and exuberance about the markets because we were headed towards a Fed rate cut in September. But if the rate cut comes because you have a horrible economy and you have a hard landing, that's really not great news for risk assets. So we're now seeing big declines across the board. Those banking shares in Japan taking a big hit. MUFG shares falling as much as 21% as well. A record intraday decline.
This is the Japan is the head scratcher for me, Shery, because as you've pointed out and asked almost every guest, what's going on when it comes to the Japan equity rally? Yes, we knew that the BOJ was headed in this direction. Yes, it was a quicker move than expected. But take a look at MUFG, right? the profit beat estimates. That tailwind is expected from rising rates. Financials, are arguably best placed in this environment, and yet you see the drop of 21% in a record intraday decline. So, yeah, if you have any ideas, let us know. But in the meantime, we'll obviously be watching.
You say it's a head scratcher, but it's a head scratcher for me too. I'm here and I'm looking at all of these moves and I'm going, what's happening? Because the initial reaction really to the BOJ was that it was a dovish hike, and then it was, no, it is going to be hikes, and now we're back to, yeah, probably they can't.
You know what, I'll be watching India, of course, right? Because the promise of earnings continuing to be robust have analysts really expecting that market to continue to extend that record rally. So we'll see if they can withstand this broader downside sentiment. Also, we have special coverage kicking off of one of India's biggest, most controversial business groups. Our exclusive interview with the billionaire founder of Adani, Gautam Adani, is with us and revealing really how he's put in motion one of the world's largest and most challenging succession plans, Shery.
And Haidi, that's even as the Adani Group continues to face fallout from that short seller report that last year wiped $150 billion from its market value. Adani also dismissing allegations that the conglomerate's dominance in key sectors of India's economy is due to his relationship with the Modi government.
It's been a volatile few years for Gautam Adani. The Indian billionaire has built the Adani Group into a sprawling conglomerate that controls large and critical infrastructure projects in one of the world's fastest-growing economies. While it's made Adani one of the world's richest people, it's also attracted accusations of cronyism over his close ties to Prime Minister Narendra Modi, as well as questions about corporate governance. In January 2023, those concerns erupted onto the global stage when short seller Hindenburg Research accused the Adani Group of fraud and stock price manipulation. Though they denied those allegations, the report still triggered a $150 billion meltdown in shares of the group's listed firms and cast a shadow over the company, just as it was eyeing a wider global play. The stocks have since then pared most losses, and the Adanis have tied up fresh lines of bank and equity financing and won a reprieve from India's Supreme Court. But fears linger as investigations by India's market regulator and the U.S. Department of Justice continue. It's with this backdrop that the 62-year-old founder spoke to Bloomberg's Anto Antony to say he's setting in motion a succession plan that will hand the running of his massive conglomerate in about 8 years to the next generation of his family, which he dubs the G2. Adani limited on-camera questions to succession. We asked him about the impact the short seller report and its aftermath had on this transition plan.
Mr. Adani, you said that the succession plan was conceived about 10 years back. Now the last 2 years incidents, the investigations, Hindenburg report, has it affected it in any way, the implementation?
In hindsight, I can say that it is this incident makes family more together and work very hard to fight it back. And I definitely basically see that they have converted this incident into the great opportunity for family uniteness. Secondly, they work hard, and whatever corrections in each and every aspect of our businesses we have to do. And in fact, basically this Hindenburg issues of this last year was Adani Group history is the highest performance.
Many people attribute your business growth to how you strategize your company's priorities to that of the government's priorities, whether it is state or center. Is that something that you will ask the next generation to continue?
No, so that is basically group has decided, irrespective of the government. Okay, when whatever the government basically decide the priority for the nation's point of view, we always basically focus our business in that direction. And I strongly believe that when you basically business directions towards government priorities, you always basically get the tailwinds and not the headwinds. And that helps your group to grow faster.
That strategy has meant the Adanis now control big chunks of India's infrastructure, including ports, airports, and data centers. So the decision on how the Adani Group will be managed in the future will have ramifications beyond the conglomerate and the family.
Tell us about your succession plans. What steps are you putting in place to ensure that this goes on smoothly for the investors, the family, as well as the company?
Succession is a very, very important for the business sustainability. And it must be organic, gradual, and a very systematic. Succession is not one of the events, but it is a long-term journey. And my plan of succession started almost a decade ago. And I gradually inducted our G2, Pranav, Karan, Sagar, and now Jeet. And the successions will be completed according to my planning in next 8 to 10 years. And all the G2 members of our family were given the best of the professionals' educations. They were also trained in the fundamentals of each and every businesses. They started as interns with our professional CEOs, and gradually they evolved into the leadership roles. Today, all of them looking after the different businesses, and I'm very satisfied with their progress. I'm really proud that all 4 of them are very, very hardworking and very grounded, and they enjoy their work, and most importantly, they all still hungry, which is not very common among second-generation entrepreneurs.
What systems are you putting in place to make sure that the group continues to grow without any internal conflicts?
These integrations will never happen in the Adani Group. When I gave the G2 the options of independent businesses, they decided collectively that they want multiple businesses but one family. So they have a strong unity among themselves. The succession is all about both continuity and change, and it is a gradual process. This will ensure that the succession is seamless, is a smooth, and a sustainable. The structural succession plan is supported by a strong cultural values. Our values provide the glue that holds together our arrangement.
And once the transition is complete and once you have more time at hand, what would be your plans?
Ultimately we will retire and be more relaxed.
Adani Group Chairman Gautam Adani there speaking exclusively with Bloomberg's Anto Anthony. Let's bring our next guest, who says the risk is pretty high in Indian family businesses where a single entrepreneur has been the driving force. Joining us now is Kawal Ramachandran, who's the Professor of Entrepreneurship at the Indian School of Business. Kawal, really great to have you with us. Talk us through what you see as the main risks and what are some of the sort of likely scenarios that could play out here for Adani.
It's good to know that Adanis are planning for the succession, and as Mr. Adani said, the process has been going on for some time. I think that the major risk is in terms of continuing to implement it. And the most important point is that when the leader leaves the scene, what happens? As long as the leader is around, a lot of this continuity or united approach will continue to be there, will be easy to implement. But what happens if the leader is not there? And yet another thing is that Mr. Adani has such a huge personality, overwhelming personality. So how is he going to redefine his role, and how is the group going to sustain itself without him being on the stage? I think that's going to be the biggest challenge. Yet another thing is that the decision-making process among the next generation members, that's going to be a big challenge. And easy to say at this stage that they are all united, that's fine. They are all part of the family, that's also fine, which is very good. But going on, is this unity going to be sustained across the business decision-making process? Yet another challenge is in terms of the process of professionalization. What do we mean by professionalization? Is the let go going to happen continuously or not? So there are challenges on those fronts as well.
It's interesting you say they're great entrepreneurs but weak at institution building. If you flip that though, could it be better for the business and better for investors if you have this business being run in a more technocratic way rather than relying on, as you say, the strong personality and leadership of one person?
And I believe that yet another related issue is that the cohesion that is going to be sustained. Why should the family be all at the forefront always? The family can be the operating owners, the strategic owners, doesn't have, and very great entrepreneurs, but doesn't have to be the face of the company. The company must have a face of its own. That's our institution. The individuals should not matter so much. I think that's a big challenge in the Indian context. In most of the family businesses or family-controlled businesses, the family believes that they are the best people to drive it. Of course, they have their own investment, they have their own stakes are there, but that kind of a transition is a big challenge. And I hope they will be able to manage that as well.
What are some examples of successful successions that you've seen in recent memory in India?
There are many cases. I mean, I would say that the best example I can think of is the Dabur, the Burman family, which has 5 generations old. They made the change maybe 20 years ago, but then continued to have that kind of a change. The family withdrew from operation. Families at the governance level, at the board level, they strategize. They don't get involved in operations. There is a family constitution, family governance, which says that the family should not get into the operations. But they have an oversight. And that's one best example. The Murugappa family also has been managing. The Murugappa family is a large family, giant family from that angle. Some 30, 35 or even 40 members are there. They have managed it over 4 or 5 generations. But recently, for instance, Dr. Reddy's laboratories from Hyderabad, there the chairman who built it up, the second generation son-in-law, Mr. G.V. Prasad, who built it up very well, he has withdrawn from operations. He continues to be a co-chair, but not involved in operations. So there are quite a few cases happening. And just one more point is that there is greater recognition within Indian business groups, the need for succession. But the biggest challenge will always be the process of implementation. And for the leader to leave the scene confidently without looking back and saying that the organization is evolving as an institution, or he or she has laid the foundation for the organization to be an institution. I think that's going to be the biggest challenge.
Kal Ramachandran, good to have you with us, professor at the Indian School of Business, about family successions in Indian conglomerates. And our special coverage of the Adani Group continues all week. We have more ahead. This is Bloomberg.
All right, take a look at what we're seeing when it comes to this markets, in particular when it comes to the stock sell-off, the Treasury rally and the broader sovereign rally that we're seeing as well. The latest move, we're seeing the 3-year bond futures here in Australia surging to the highest since June 2023, on the back of the 2-year Treasury yield dropping 11 basis points to the lowest since May 2023 as well. We're seeing really capitulation when it comes to some of these stock indices. The Nikkei 225 down by just about 5.5%, the Topix over 6.5%. We've had that circuit breaker being triggered for the Topix index until 9:26 Japan Standard Time. The Topix is now down, 20% from the July peak. Let's make some sense of this. Hopefully, Garfield Reynolds is with us. He leads our Markets Live Asia coverage and is with us now. And I mean, MUFG, profit, the earnings are really good. They're supposed to benefit from higher interest rates in Japan. They've fallen a record high of 21% so far this morning's session. Are there some parts of this sell-off that is nonsensical? Or at least difficult to understand at this stage?
Not really. In many ways, it's your classic panic moment. You know, you think of the way that all the way up for Japanese stocks, for US stocks, there were these lingering concerns that everything was going a little bit too high, too rapidly, and especially as some of the evidence started to build that economies were starting to crack in the West, and also even in Japan. There were some concerns about the Japanese economy, and yet everything kept on moving higher. You'd have the occasional dip, but then the dip buyers would come in. So you've got a situation where investors around the globe are having to rapidly reassess their previous assumption that the US economy in particular was relentlessly and endlessly resilient, that any dip was just a buying opportunity. So in that environment, there are some moves such as MUFG, which I have to admit I have not looked closely at, so I could be completely wrong on some of the specifics. But the general point is, when a major meltdown like this happens, investors get caught out, they have to adjust, they have to sell. And sometimes what they end up selling is the stuff that's done the best so far because they want to lock in profits. This is a time to look around and say, okay, where can I lock in profits? Where does it make the most sense to get out? Or it might be, well, I need to sell this, this, and this. Those are all actually underwater now, although 2 days ago they were above water. So I'm taking losses. What can I sell to make myself whole?
What is the worst case scenario here? Because I remember the last time we got a circuit breaker triggered on the topics, I think was during the height of the pandemic, and then we lost, about 30% since then? What's the worst case scenario?
Well, I actually think the worst case scenario would be that we end up with a slow grind from here. We've got this big sell-off Friday and today. That should get exhausted at some stage over the next 24 to 48 hours, might be over the next 24 to 48 minutes. Things will calm down. There'll probably be some level of rebound. I was saying earlier that what's going on, this was before things really took off again once the Japanese markets opened, that this sort of selling only makes sense if we are on the cusp of a major recession. So if you don't think we're on the cusp of that, and there are plenty of reasons to think that while we're on the cusp of a decent slowdown, we're not necessarily on the cusp of a major recession. If that's your judgment, you should start looking around for, okay, a lot of stocks are much less expensive than they were. Maybe they're even looking cheap. Are people going to go back into them? Same with bonds. The bond moves are extraordinary. Yeah. So you're also going to have people saying, once things calm down, and the things calming down, you also need the Middle East to calm down so you can get some clarity there. That's definitely not helping. So once things calm down, you should get a bounce. You should get some gains. The question is again whether those gains can sustain and whether we end up heading lower, especially if we end up grinding lower. That would be the worst case scenario.
Calm your farm, as they would say here in Australia. Garfield Reynolds, who leads our Markets Live Asia coverage, as we continue to watch for really some of these extraordinary moves across markets this Monday morning. More ahead on the Asia Trade. This is Bloomberg.
A sea of red across early trading in Asia as we look ahead to the opens in China. Of course, we had a little bit more details when it comes to Beijing's priorities to spur consumer spending over the weekend. We'll see if that really supports the stock market at a time when we have the topics now continuing to lose ground. The Nikkei as well, the Kospi could end up in correction territory if we end up at these levels. That's it from the Asia trade. Our markets coverage continues. This is Bloomberg.